Have you ever wondered what exactly is this stock market everyone keeps talking about? Well, imagine a bustling marketplace, but instead of fruits and vegetables, people are buying and selling pieces of companies. That, in its most basic form, is the stock market. It's a place where the ebb and flow of commerce takes on a life of its own, as shares of publicly held companies are issued and traded. These transactions happen either through formal exchanges akin to a well-organized supermarket or over-the-counter markets, more like a lively bazaar where negotiations are the order of the day. In this dynamic ecosystem, the fortunes of companies, and indeed the economy itself, are constantly changing hands. Every day, billions of dollars worth of shares are bought and sold, shaping the world of business and finance as we know it. But what are these shares and over-the-counter markets? Let's dive deeper. Imagine owning a piece of a giant corporation without having to do any work. This is essentially what a share or stock is. In the grand theatre of the business world, shares or stocks play a pivotal role. They represent your piece of the pie, a slice of ownership in a company. When you buy a share, you're essentially buying a small fraction of that company. You become a part owner, a shareholder, if you will. And just like how a larger slice of pie means more dessert, owning more shares means a larger stake in the company. Now you might wonder, how is the price of these shares determined? Well, it's all about supply and demand. If a company is doing well, more people want a piece of that success. They're willing to pay more for a share, driving the price up. On the flip side, if a company isn't faring so well, demand for its shares may drop, and with it, the share price. But it's not just company performance that influences share prices. External factors like economic trends, political events, and even public sentiment can sway the market. You see, the stock market is a bit like a giant global mood ring. It reflects the collective emotions and expectations of investors from around the world. And just like in any marketplace, prices fluctuate. They rise and fall, sometimes rapidly, sometimes gradually. This constant ebb and flow, this dance of numbers, is a big part of what makes the stock market so intriguing and at times so intimidating. But don't be daunted. Owning shares is not just for the Wall Street wolves. Anyone can become a part owner in a company. And with the right knowledge and a dash of courage, anyone can navigate the thrilling twists and turns of the stock market. So, you now know what a share is. But how do you buy one? To buy or sell stocks, you need a marketplace. That's where stock exchanges and over-the-counter markets come in. Imagine a bustling marketplace, but not the kind with fresh fruits or exotic spices. Instead, this marketplace deals with stocks, the shares of a company that represent ownership. This is the stock exchange, a centralized location where buyers and sellers meet to negotiate prices and make trades. Stock exchanges provide a transparent, regulated, and convenient venue for these transactions. They operate under a simple principle: supply and demand. If more people want to buy a stock, demand, than sell it, supply, then the price moves up. Conversely, if more people wanted to sell a stock than buy it, the price would go down. Now, if you're picturing traders yelling out orders in a crowded room, you're not far off. But in today's digital age, most stock exchanges are electronic and trades are made at lightning speed. But what if I told you there's another way to trade stocks, off the beaten path of the stock exchange? Welcome to the world of over-the-counter or OTC markets. Here, trading happens directly between two parties without the oversight of an exchange. It's like buying a car from your neighbor instead of a dealership. OTC markets often deal with companies that can't meet the strict requirements of a stock exchange. It's a bit more risky, yes, but it can also offer opportunities that exchanges don't. And there you have it, two different marketplaces for buying and selling stocks. Whether you're in the grand halls of a stock exchange or the back alleys of the OTC markets, remember this: every trade is a bet on a company's future. It's a game of predictions, where the stakes are as real as the money in your pocket. Now that you know where to buy stocks, let's talk about how you decide which ones to buy. You've probably heard of the Dow Jones, Nasdaq, or S&P 500, but what do these names mean? These are all stock market indices, and they serve as thermometers for the financial world. They're a measure of the performance of a specific section of the stock market. In essence, they're a benchmark that investors and analysts use to track the health of the market and to compare individual investments. Imagine a vibrant, bustling marketplace with stalls selling various goods. Now, if you wanted to get an idea of how this marketplace is doing overall, would you go to each stall and check every single item? Not really. A more efficient approach might be to select a sample of stalls and products that represent the entire market. That's essentially what these indices do. They are a sample of stocks representing the overall market or a specific sector within the market. Consider the Dow Jones Industrial Average, often just called the Dow. It consists of 30 significant stocks traded on the New York Stock Exchange and the Nasdaq. These 30 companies are considered a barometer of how the entire industrial sector is performing. Then there's the Nasdaq Composite, which includes all the companies listed on the Nasdaq Stock Exchange. It's heavily influenced by the technology sector, so it's a good measure of how tech stocks are doing. The S&P 500 might be the most commonly referenced index. It includes 500 of the largest companies listed on the stock exchanges. Because it represents such a wide range of industries, it's often used as a proxy for the entire US stock market. These indices can help investors decide which stocks to buy. If an index is doing well, it might be a good time to invest in the stocks that make up that index. But remember, investing is never a sure bet. Just like in our marketplace analogy, while it's helpful to look at the overall picture, to make a wise investment, you must also examine each stall or stock closely. Indices give you a broad view of the market, but to make a decision, you need to look closer. Choosing which stocks to buy is a bit like detective work. You need to gather and analyze information. But how do you decide which stocks to put on your radar? That's where the art of analysis comes in. There are two primary types of analysis, fundamental and technical. Fundamental analysis is all about understanding the business behind the stock. It's like peeling an onion layer by layer to understand the core. You'll examine the company's earnings, revenue, and other financial indicators. You'll scrutinize its management team, its competitive advantage, and its market sector. This method is for those who believe that the company's intrinsic value will eventually be reflected in its stock price. On the other side of the coin, we have technical analysis. This method is a bit like weather forecasting, but for stocks. Instead of clouds and wind speeds, you'll look at price trends and trading volumes. You'll study charts and patterns to predict future price movements. It's less about the company's health and more about market psychology and investor behavior. Both methods have their merits and their champions. Some investors swear by fundamental analysis, basking in the glow of balance sheets and income statements. Others prefer the dynamic dance of technical analysis, charting the ebbs and flows of market sentiment. But here's a little secret. The best investors use both. They understand that stock prices are influenced by a myriad of factors, both tangible and intangible. They know that a company's financial health is important, but so is the mood of the market. They use fundamental analysis to identify promising stocks and technical analysis to decide when to buy or sell them. And so, the art of analysis is not about choosing one method over the other. It's about using the right tool for the job and understanding that no tool is perfect. It's about making informed decisions and being comfortable with the inherent uncertainty of the market. And there you have it, a basic understanding of the stock market and its key terms. Now that you're armed with this knowledge, you're ready to dive into the thrilling world of stock investing. The stock market can seem complex, but like any journey, it starts with a single step. Like embarking on an adventurous trek, you first need to gather your essentials. In this context, your essentials are knowledge and understanding. Start by learning the basics: shares, stocks, buying, selling, indices, and analysis. Don't be daunted by the buzzwords and the jargon, they're just part of the landscape. Like a hiker learns to tell the difference between a birch and an oak, you'll soon distinguish between a bull and a bear market. The internet is a treasure trove brimming with resources, podcasts, ebooks, online courses. The world is your oyster. And don't forget, you're not alone on this journey. There are communities of traders and investors just like you, ready to share their experiences and insights. Remember, every expert was once a beginner. Start your journey today.